Everybody. Thank you for joining today, and thank you to the Illinois Institute of Technology and Trustee Bob Howell to invite me. If you want to receive the slides that I'm going to show today, you can email me, patrick@bourbonfm.com. I will show you the email in 1 second. If you have any questions, you can type them on your screen. I will try to address them during or at the end of the webinar. And if you cannot watch the webinar for the full time, we'll spend about 45 to 60 minutes. So there will be a replay. So you can send me an email, and it will be also posted on the IIT website. So now you should see only the slides. So we're going to talk about the important information that you should know to prepare for a better financial future. It's also called Investment 101. So the first slide, I like to show some quotes. I will just read the first one that I like the most. It's from Warren Buffett. We simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful. So right now, maybe you can see your friends that tend to be greedy. The market just went up 400% since March 9, 2009. You quintuple your money. Since Christmas last year, market US stocks went up 25%. So people tend to be greedy, but it's not the time maybe to be too greedy and more to be fearful. So what are we going to talk about today? First are the potential issues people face. Second is about asset allocation and diversification, which will be solutions about its strategies, solution about those issues. And at the end, we'll talk more about the stock market. So first is about retirement. It could be longer than what you think. For example, if you are 65 years old today, the probability that one of the 2 persons in your couple live until 95 years old, which means 30 years in retirement, this probability, if you have a healthy American couple, is 43%. So people don't realize that retirement could be longer than what they think. So you have to prepare for that. That's one issue. Another issue is about the cost of healthcare. This is a research that is few years old. The numbers are even bigger today, but it shows that when you retire today at 65 years old, you may spend close to $300,000 in healthcare costs. That may be more than what you think. Another issue is inflation. It's the fact that prices tend to increase over time. You can see on the right side some charts where the red line is the tuition and fees for college, university. They went up more than 1,000% since 1978. Medical care cost, 600%. You see the cost of a stamp at the bottom right. In 68, it was only 6 cents. Now we're getting closer to 50 cents. On the bottom left side, you see the cost of bread, 72 cents in 91 and 1.42 in 2011. That's inflation. So you have to think about that when you plan for a long term. Another issue is taxes. You're going to decide to invest your money to better prepare for retirement, for healthcare costs, for the rising cost of college tuitions, etc. But if you invest in a brokerage account at Schwab, Fidelity, TD Ameritrade, when you buy a mutual fund, you have to realize those mutual funds may generate taxes. In this case, this PIMCO fund went up 7% that year. But after tax, it was close to minus 40%. Minus 14% and 8% is a big gap. This is because a mutual fund generated 1099. They have distributions potentially every year, and you receive this form in February, and you have to pay tax on those potential gains of the mutual fund. Even if your mutual fund goes down, you may receive a 1099 and paying taxes. So pay attention to taxes. Another issue is people may not realize how much they need to retire. They think they have enough. So you have to analyze your after-tax income, your expenses every year. Try to forecast that until the end of your life to see if you're going to have enough cash. Another way is to use this magic number I'm showing on the screen. It's a wrong number, but it may not be that wrong. So a quick and easy way to find out how much you need to retire is to take this amount you may need every year. So let's say you want $100,000 per year to live, and you divide it by this magic number. In this case, 3.2% if you are 60 years old. What you see is 100,000, or whatever number you want, you divide by this 3.2%, it will give you the potential capital you need to retire. In this case, $3.1 million. It may be higher than what you think. Another research showed that $100,000 needed for retirement if you plan to retire having a 35 years in retirement. You see they show that you need a 2.5 million of savings. Again, maybe more than what you think. And remember, if you plan to retire in 20 years, the cost of things will be higher because of inflation. So $100,000 in 20 years may only be $55,000 today if you assume 3% of inflation. So if you spend $50,000 today, if you want to buy the same thing in 20 years, maybe you will spend $100,000. So you may need 2.5 million when you retire. Another issue is that the average investor tends to make investment mistakes. You see on this chart that the average investor during that period, 97 to 2016, only won around 2.3% per year. He may have sold at the wrong time, bought the wrong product. If he had just bought the S&P 500, an index of all large cap US stocks, this index went up 7.7% per year. That's a big difference. You can see in terms of number that 57% cumulative performance over 20 years for the average investor will have made your $100,000 grow to $157,000. If you had invested not even in the stock index, in 60% in stocks, 40% in bonds, you will have had a balanced portfolio between stocks and bonds. Those $100,000 would have grown to $379,000. It's $200,000 more than what the average investor would have done. So that's a big difference. That's another way to show the same information, that the average investor between 1983 to 2003, he underperformed the average mutual fund, which is managed by professionals, because the average investor does not know which stocks to buy and sell. So it's easy to understand that they may underperform by 2% or more. In this case, $100,000 will have become $400,000 with the average investor, and in a mutual fund, it will have become more than $700,000. That's a big gap when you look at those 20 years. The next slide, you see another issue, that the average mutual fund, which we have just talked about, but is not that bad. It helps you to make more money compared to the average investor. But this average mutual fund underperform an index. If you just have bought a US index, you will have made 13% per year during that period, not 10.3. So your $100,000 will have become $1.1 million, much more than the $700,000 you will have made investing in funds, and much more than the average investor will have made $457,000. Next, I wanted to show that some funds are still good, meaning Warren Buffett did a good job. You have great investors around, but they're hard to find. In this case, I show this green line of the S&P 500, so an index. I just told you that investing in an index is a great way to build wealth for your retirement. But during that time frame between 2000 and 2010, the S&P 500 went down 1% per year. It was a tough period, 2 recessions. But some funds did well. In this case, it's a fund called Royce Premier. It went up 9.86% on average per year. I was lucky because when I joined UBS in 2000, that was one of the few funds that they offered in the 401k. So I spent 10 years at UBS and I was able to invest in this fund and have a great return during that 10 years. This slide shows what happens if you decide to invest or if you decide to keep the money in cash in a checking account at 0%. As you know already, if you invest, and in this case it was an example investing at 8% per year for the 30 years, you see that $10,000 invested per year would have become 1.2 million by the time you retire. If you just invest in a checking account 10,000 a year for 30 years, you will have had only 300,000, much less. Lots of information on this slide. The idea is that if today you decide to improve a little bit your portfolio and maybe have just 1% more returns per year until you retire, and let's assume you just graduated. This portfolio, if you just make 1% more per year, would have lasted 12 more years at retirement. Big impact. 1% is equivalent to 12 more years. So the example here is someone who started with $0, just graduated, 25 years old, starting salary $40,000, and is going to contribute 10% per year of his income. Is going to retire at 65, and you see those difference. This 100 basis point more, 1% more return, the portfolio will have lasted until over 95 years old instead of 84 years old. So one of the main strategy for those issues I told you at the beginning is to start to invest early. This slide is about the cost of procrastination. Why should you start to save today? There are 2 people, one who starts to save today, the first green line on the left, and this person is saving $10,000 per year for 10 years only. After that, he does not want to save anymore. He wants to spend more time traveling, buying French wine and cheese, whatever he wants to do, but just 10 years of savings. So he saved $100,000. But because he invested, this money is going to continue to grow during the following 20 years until he retires. The second person didn't know about that. So the first 10 years, he didn't save much. After 10 years, he decided, oh, let's plan for retirement and let's save $10,000 per year until I retire. So he's going to save for 20 years, $200,000, 2 times more than the first person. But as you can see, this $10,000 for 20 years only goes up to $500,000. Never catch up with the first person who saved half less, who has maybe at retirement $700,000. It's close to 50% more. So start early. That's the same idea about why should you start today to save. If you start to save at 20 years old, if you want to have $1 million when you retire, you only need to save $310 per month. If you are 50 years old and you decide to be a millionaire by the time you retire, you have to save $3,294 per month. That's more than 10 times more per month. What do you prefer? Now we're going to talk about asset allocation and diversification. Asset allocation means you have to diversify your asset between stocks, bonds, alternative, real estate, cash. That's the asset allocation. You can see how the millionaires allocate their assets in Europe or in the US. You have many research, different time periods that shows that asset allocation, how much you put in stocks versus the rest, is the most important factor that drives the variability of the return of the portfolio. So pay attention. Every year you have to check your asset allocation of your portfolio. You have to diversify. So this is a table showing year by year 5 different asset classes. The yellow is international stocks, green S&P 500, orange mid-cap value stocks, purple mid-cap growth, and blue US bonds. And you can see every year they have different returns, and I have no idea which color is going to win the next year. What you can see is 2001, 2002, bonds were great, the best asset class. It was a recession. So typically people tend to buy what worked in the last few years. And as usual, it's a typical bad decision. You see US bonds the following 4 years was the worst asset class. 2008 was the best again. So trying to forecast this is too difficult. But what we recommend to our clients is a diversified portfolio. We buy a little bit of everything. So in this case, it's purely hypothetical, but let's say you buy 20% of each of those 5 colors. So your performance is always going to be average. You see the dark green boxes. But if you look over the long term, between 94 and 2008, 14 years, this diversification worked. It was the second best portfolio that you could have built. We had no idea in 1994 that mid-cap value stocks, the orange color, would have been the best. Another slide about diversification. If today you have $100,000 in portfolio A, you invest at 6% per year, maybe you're going to have $574,000 in 30 years. But if you diversify and you buy 5 products with a 6% average return, you could have 74% more if one of them is a good one. Maybe one of the fund you picked went up 12% per year in the next 30 years. Maybe one will do 0. I don't know. But diversification has worked. Why you diversify is because stocks sometimes goes down. Stocks are represented by the blue bar. You see in 2008 went down 40%, 2001, 2002 went down. All those years represent stocks when they went down since 1929. But what do you see is that if you invest in bonds, which is the orange line, usually when stock go down, bond goes up. So it's good to have some bonds in the portfolio. If you have $100 and your portfolio goes down 50% and goes up 50%, you don't go back to $100. You go back to $75. So you don't want to go down 50%. You don't want all the stock risk. You need to diversify the portfolio. This is an example that people have a hard time to believe. 3 years, you invest in fund A and fund B. Fund A did 0.2%, Fund B did 3.7% over 3 years. 60% in Fund A, 40% in Fund B. So over 3 years, you made 1.6% per year. Now, if you look at this table, if you start to invest in a Fund C that has a negative return, it went down 3.5% over 3 years. Maybe it's good for your portfolio. So yes, I'm saying that sometimes it could be good to invest in a fund that goes down even if the other ones are going up. You may end up with more money, which is the case of this slide. You went up 2.5% versus 1.6%. But the trick is to invest in uncorrelated assets. So you have to understand what you invest in. So to finish, we can talk about the stock market, because that's what will help you on the long term to beat inflation after tax, which may not be the case for bonds. So the stock market since 1900 went up a lot. You can see that. $1 investing in the stock market in 1900 will have become by 2009, before this huge bull market we just lived since March 9, 2009, this $1 will have become $582. And that's adjusted for inflation, because if you don't adjust for inflation, you may have $20,000. But let's talk in real terms. So stocks are pretty good. But you can see the blue line, they go up and down. So that's the issue, it's volatility. Some people prefer to invest in bonds. That's a gray line. And you see that $1 became $9.9 in 2009. That's a big difference. I'm not sure what is more risky, because how do you define risk? Maybe risk is that you're going to run out of money at retirement. You're not going to have enough to pay for healthcare. So if this is how you define risk, stocks will make you more money and reduce the risk of running out of money at retirement. Another way to think about this is look at this gray line between 1940 and 1982. $5 in 1940 invested in bonds would have become close to $1 40 years later, adjusted for inflation. Maybe this is risky. If you are in a period with higher inflation, when bonds are not doing well, losing 80% of your asset in 40 years may be risky. This is a slide to show the stock outperformance, but it's for the long term. And if you wait 30 years, you have a very high chance that stocks are going to beat bonds, historically at least, since 1871. But if you have your horizon in 1 year and you say, oh, I want to buy this nice house in 1 year, buying stocks is a gamble. As you can see on the left side, you have 60% chance that stocks may beat bonds over 1 year. So remember that stocks are for the long term. That's a histogram to show you how stocks have behaved historically. And you see most of the time, stocks will give you between -10 and 30% of performance. The problem is sometimes I give you -20, -30, -40%. So you have to think about this left tail. You have to make sure you don't need the money on the short term when you invest in stocks. That's another chart, a table showing the stock market, the S&P 500, and the performance when the performance is negative, when you lost money. So you see the S&P 500 over 1 year, you had close to 24% chance to lose money over 1 year. But if you put your money in a checking account in the T-bills, you have 0% chance. Gold, you have 39% chance. So you have to understand that the stock market may go up and down and you have a potential negative return. We talked about inflation earlier. That's one of the potential issues for the long term. This shows how inflation behaves historically, but on a 17 years compound annual growth rate, so on average over 17 years. So you see in 1939, the previous 17 years had negative inflation. It was a tough time. But if you look at 1984, the previous 17 years, so since the 60s, late 60s to 84, you realize inflation was 6.94% per year. That was high. How do you solve this potential issue? You buy stocks, as you can see in the comments, over any 20-year period since 1926. Any of those 20 years you take, stocks beat inflation. If you want to invest in bonds only because they are less volatile, 16 times you will have lost versus inflation. And cash is even worse. Some people like to read newspaper, watch the TV, watch the stock market, try to do some market timing, thinking, oh my gosh, this is high, this is cheap, let's buy. We have no idea what the stock market is going to do tomorrow or next week. But what we know is that historically, in this case, it's from 97 to 2016, but any time frame you take, it's the same conclusion. If you invest, in this case, $10,000 in 1987, and you don't touch it, you just keep it in stocks, you wait 20 years, even though we had two horrible recessions in 2001, 2002, and 2008, where we lost 50% two times. But over 20 years, you made 7.68%. Not that bad. Your $10,000 became $43,000. But now if you think you are smarter than the market, you think that, oh, market is going to go down next week, next month, whatever, and you try to do market timing and you miss the top 10 days of those previous 20 years, now your return is only 4%, no longer 7.68, and you no longer have $43,000 to retire, you only have $21,000 to retire. That's a big difference. So you can lose half of your retirement income if you miss 10 days over 20 years. 20 years is a lot of days. It's about 5,000 different trading days, and you don't know which ones are going to be good or bad. So in conclusion, retirement may be long, healthcare costs may be higher than what you think, inflation and taxes have large negative effects to reach your financial goals. The capital you need to retire may be higher than what you think. So you have to start to look at your cash flows. After tax, income, your expense, is that okay? The average mutual fund underperform an index, and an average investor underperform an average mutual fund. The cost of procrastination is impressive. You have to start to save today. If you start to save after 55 years old, it will be much harder. Asset allocation and diversification are very important. Stocks outperform, but they are more volatile. They can lose 50%. And don't try to do market timing. So we started with some quotes. So let's finish with some quotes. And in summary, what they mean is pay attention to what people do and note what they say. I didn't introduce myself at the beginning. I'm the founder of Bourbon Financial Management. I created it with 2 other people 10 years ago. The previous 10 years, I spent it at UBS in Chicago. I'm from France originally. I got a master in engineering in France, went to Chicago to IIT for a master's in finance. I got my CFP, CFA. I used to manage billions of dollars. How do we help people? We are independent. We diversify portfolio. We rebalance. We help with the fund selection. We do lots of education like this one. And why people choose us? Because we are affordable with straightforward flat fee. We are fee only, no commissions, contrary to most people. We don't have minimum assets. Clients keep the full control of their assets. We have a disciplined investment process, and we are an independent fiduciary. Fiduciary means that we have to act prudently and in the best interest of the client. If you talk to a broker in large banks like UBS, Merrill Lynch, Morgan Stanley, they may not be a fiduciary. More about us: we build globally diversified balanced portfolio. We focus on asset allocation, disciplined investment process. We own the firm. We don't have to work for shareholder trying to sell product to make money for the shareholder. We are not publicly traded. And that's how to contact us. So if you have any questions, I went kind of fast. Feel free to use the chat room, or you can send me an email at info@bourbonfm.com. I can also send you the slides. And you can also watch the replay and click on pause when I started to talk too fast, or if you want to spend more time on some slides. Thank you, and let me know if you have any questions.
Thank you, Patrick. I'm going to wait just a minute or two to let folks type their questions into the chat window. And like Patrick said, if you don't want to ask questions in the chat, you can always email him after the presentation as well. But we'll wait for a minute or two before we sign off to see if anyone has questions they want to ask right now. Patrick, so we have a question that came in, and the question is, what would be the first step you think a recent grad should take to get started in investing?
So first, we'll be focusing on your savings. On average, Americans save about 5% per year. That's not enough. In Europe will be higher. China will be even much higher. Maybe in China, they say 40% per year. 40% may be high, but if you start to save 20% of what you make until you retire, you're not going to have big issues at retirement. So first thing is focus on saving. Second thing is lowering your taxes. So maybe your company has a 401k plan. You can put up to $19,000 a year in a 401k plan. Those $19,000 will be deducted from your revenues when you calculate taxes. So if you pay 30% taxes total, maybe you're going to save $6,000 a year of taxes just because you put money in the 401k. Another account which is even better is called HSA, Health Savings Account. Depending on the health insurance program you have at your company, you may have access. If it's a high deductible plan, typically you will have access to an HSA. HSA, if you're married, you can put $7,000 in this account every year. And you can invest it in funds too. Don't use it for healthcare, just put it in the HSA instead of a brokerage account where you will be taxed. So what happens when you put money in the HSA? $7,000 a year, maybe you save $2,000 in tax, of income tax. Second benefit, the money can grow. and you're not going to receive a 1099 form. The mutual fund are not going to generate taxes because it's inside the HSA, and it's a benefit that is maybe giving you 1, 2, 3% more returns per year compared to a brokerage account. Third, at retirement, you can take money out. There are no penalties, and there may be a way to avoid income tax at retirement on the money you take out, contrary to the 401k. 401k, when you take money out in 30 years, 40 years, you may be paying income taxes. Depend on your tax bracket at the time. Maybe it will be lower. That's why people do it. But HSA, the third benefit that you don't have in the 401k, you may avoid income tax if you show during your life that you have had healthcare expenses. So another thing for you to do right now, you start to collect your healthcare expenses that are not reimbursed. And maybe in 40 years, you're going to say, hey, look, in 2020, I had $10,000 of healthcare expense, and you may take out $10,000 of HSA money without any taxes. Maybe at retirement, you will have healthcare expense, and that won't be an issue. But if you are very healthy and you have no healthcare expense at retirement and you want to take money out, just keep your receipts right now. So that's a few things you can do if you don't have HSA, if you don't have 401k, which happens to very few people. At least do an IRA or a Roth IRA. You can put $6,000 a year inside. You may or may not be able to deduct it, but at least you have some tax benefit by doing this IRA. If you have kids, you could open a 5 to 9 plans. Maybe you put 15,000 for you, 15,000 for your wife, and if you have 2 kids, you can put that 2 times, so that may be 60,000 that you put in this account. Maybe you do 5 years of contribution in one time, so you can put $300,000 for your 2 kids right away, and this money can start to grow, and you don't pay tax every year. So that's some of the options you may have when you start to graduate.
Thank you, Patrick. Another question, similar, is how would you recommend that young adults balance investing with other financial priorities like paying student loans or paying other debt?
So I didn't talk about debt, but that's a big topic. Some people, I have clients with a lot of debts. Sometimes I've had clients with more debt than assets, so they had a negative net worth. So typically, what you should be looking at is the cost of the debt. So if we're talking about credit cards at 20% interest rate, it's pretty obvious that you should reimburse your credit card if you have savings, because you're not going to make 20% on your investment. If you have a 401k, maybe your company is matching 3% of what you are investing in the 401k. That's typical, a few percent they add. Maybe it's half of the first 6%. Anyway, it's free money that your company is giving you. If you double, if you put 3% and your company puts 3%, it's 100% increase right away. So that should be a priority compared to the debt, because in this case, you made 100% of your money. But if you have a student loan or a mortgage, whatever kind of debt, but if it's very low, at 2 or 3% interest rate, maybe you don't want to reimburse too fast, because you could invest at a rate of return that is higher. The stock market went up 10% per year, I guess, for the last 100 years. Bonds may have done 6% per year. So these were the good times. I don't believe it will happen again. But anyway, I think you're going to make more than 2 or 3% by investing in stocks and bonds for the next 20 or 30 years. So it depends on everyone. Maybe you need to keep some cash and not reimburse your debt, because in 3 years you want to do a home down payment. Maybe you need $50,000 to buy this dream home. So you don't want to use all your cash for your debt, because this is a more important goal for you. So it depends, but at least I gave you some thoughts about it.
Thank you, Patrick. I don't see other questions. I hope folks will email you as well. But I want to thank you for your time, Patrick, and taking us through Investment 101. Like we said earlier, this presentation has been recorded. It will be posted on our website, and we're going to continue the Hawk Talk series in the next coming months. So you'll see other topics, and if you have recommendations for topics for Hawk Talks, please email alumni@iit.edu. Again, alumni@iit.edu for future topics. And Patrick, again, thank you for your time today, and best of luck to everyone, and enjoy the warm weather.
Thank you, Achal. Bye.
Thank you, Patrick.